One of the responses that commercial banks nationwide have engaged in as a consequence of the past 5-year adverse economic cycle is to examine the lending categories that they were pursuing at the advent of the cycle and respond both to the significant losses that were endured in the commercial real estate sector, both owner-occupied loans and those to investor properties, and also reconcile the regulatory response, which is a dramatic and gated response to hold fewer commercial real estate mortgages. Thus, banks are actively examining alternative lending categories, and within that realm are a number of categories within the specialty lending sector. Those include government guaranteed loans, both SBA loans and USDA loans, U.S. Department of Agriculture loans, lendings to specific industry sectors such as healthcare and contracting, as well as strategies involving elevated multifamily housing lending, because the regulatory capital standards are advantaging multifamily housing from the amount of capital they have to hold in relation to that category of loans. And banks that have the risk mentality to do so are also examining asset-based lending and other strategies that have to do with the financing of the turn of raw material to inventory to receivables to collected cash. In terms of government guaranteed lending, the clear positive is you achieve on your loan to that underlying small business enterprise, whether it's through the SBA 7A program or the USDA business program, you achieve a partial U.S. government guarantee of the loan, allowing you to absorb the inherent credit risk in advancing a loan to a small business enterprise that may not have fully evolved and matured and thus has or is a youthful startup enterprise. So the government guarantee helps manage the credit risk embodied in the loan. Further, both forms of government guaranteed loans, SBA and USDA, can be sold in the secondary market. And in the current environment, banks that do sell the guaranteed portion of those loans are experiencing very significant gain on sale income from that, while they retain the customer relationship by servicing the loan over its life. So that's one example of the attractiveness of government guaranteed loans. Asset-based lending is being embraced by select banking companies because of the fact that if you are able to bring in experienced personnel that have spent decades in that inventory turn cycle lending, true cash flow lending, if you can put in place the right infrastructure, human and otherwise, the risk return realities have been fairly attractive for those banks that have entered that field. They're generating better returns than they are on most other segments of their lending practice. And at this stage, even the risks have been tolerable, and it has helped their overall shareholder returns. All the specialized lending categories, whether it's government guaranteed lending, asset-based lending, specialized lending in select industry areas, higher levels of multifamily housing lending, they all require a commitment of human and physical infrastructure capital as well as financial capital, so that you don't get caught without having the right level of critical mass. It's difficult to tiptoe into these enterprises. You can have a collective effort to enter several of them with the same staffing and the same forms of capital commitment, but you have to understand and plan. You have to have a plan that acknowledges the capital commitment that is necessary to not just penetrate the market, but succeed in building an ample-sized portfolio so that the economics work out for the bank as a whole. The typical planning phase is up to roughly a 12-month time frame before actual rolling out of the strategy. And that time frame will involve a design of a business plan that would be submitted to the management team and board of directors for approval, the calibration of the necessary resource commitment that will allow the new entrants to successfully penetrate the market and gain market share in these specialty lending categories, the capital plan for the financial capital that has to be allocated to the new risk that's taken on by elevating the loan portfolio in the specialty lending spectrum, and the recruiting and/or training of human resources that will have the talent and know-how to execute the aforementioned plan.